What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down the ins and outs of how put options work, when to sell them, when to buy them, what they do, and what is the purpose of them. So if you are excited for today's video or just curious to learn more about put options, make sure you like the video, subscribe to the channel, and turn on the bell notifications for all future uploads. Now, what you will see on my screen here is Amazon, and believe it or not, Amazon is up 1.5% today, even after their outage that they are facing right now, at least in the Northeast region, or at least on the eastern coast of the US, which I am a part of. So I've been kind of dealing with the lag a little bit, and what we're going to do is we're going to break down the options chain, how it works, and the idea behind it. So let's say you're looking at Amazon and you're thinking that for some reason Amazon, it's actually sideways for most of the year, which is crazy to me. But let's say that you are bearish on Amazon. You think Amazon is going to go lower than what it's currently trading at. They do have earnings coming up, I believe, on the 30th, which is a big earnings report we have here. Is one of the major ones, and it's part of the Mag 7. And you're going to be bearish on Amazon. So what you're going to be looking at here is you're going to go to trade Amazon options. And what you will see if you have the buys and the sells, we have the calls and the puts. Now, calls are if you think the stock will go up, and puts is if you think it will go down. Now, one user on After Hours wanted me to break down puts, so I'm going to go through all the math and the ideas behind it. So, what we're going to be looking at here is, say you are bearish on Amazon. They have earnings on the 30th. So let's say you're going to be betting that their earnings will not be good. And this is going to be expiring on the 31st, about 2 weeks out. So you want to buy a put option here. Now, you can either buy an in-the-money put option or you can buy an out-of-the-money one. Right now, it's at 216. Anything below 216 is out of the money. Anything that's above 216 is in the money. So 217.5, 220. These are all ones that are in the money. Now, what you will notice with the put option chain is as you go higher up, it's going to cost you a lot more. And the reason why is because your break-even price is actually a better chance of it happening, because here break-even of 214, it's at 216. That's more likely to be at 214 break-even compared to, like, say, 207, as you'll see as an example here. And so we're going to break down the break-evens here, when to buy a put option, when to sell a put option, and the pros and cons behind them. So let's say you want to buy a put option, you're bearish on Amazon, and you want to say, you know what, Fridge, I think that Amazon will go to 215 by next Friday. So it's going to be a bearish outlook. It's going to go below 215, and that is going to be amazing. And here's something to say, well, Fridge, even though I'm buying it to say it's going to go to 215, why is my break even at 207? You said 215. And that is correct, but you have to factor in how much you pay for the option. Now, in the options chain, you are paying for 100 shares at a price of $7 each. So this was going to cost you $755 here. So even though it has to go to 215 as a break-even strike price, you actually have to factor in the cost of how much you pay for every share. So even though it's 215, you got to factor in how much you're paying for. So you actually got to lower your break-even strike down to 207. So Amazon would actually have to go down about 4% for you to break even, and anything above that is going to be profitable as a result. So again, put options are bets that it will go down, and that's going to go lower as a result. Now, what you will see also is that if you go up, like I said, say you want to buy the 230 option, you're going to say, well, Fridge, it's definitely going to be below 230, so I'm going to make money guaranteed. And that's not quite the case, because again, you got to factor in how much you're paying for every share. If you're paying $16.80 a share, you have to take your strike price, subtract the pay price that you're actually paying for, the premium you're paying per every share, and that gives you an actual break even. But what's nice about it, even though it costs you a lot more, is that the only move that Amazon needs to have is down 1.5%. And as a result, that is going to allow it to have a better chance of breaking even. And if you climb up even higher, say you go to the 260 strike price here, it's going to cost you $4,000. But Amazon basically just has to have some sort of move in the bearish side of things here. Now, the risk that you face is that if Amazon starts moving the opposite way, whether it's 5%, 10%, you start to lose a lot of capital. So these are not guaranteed to be profitable by any means, but the higher up you go on the put side, the more likely it is of you making money if Amazon sells off after earnings. So that's kind of the idea behind puts and how you would open it up. What you would do is you would hit 215 here, you would hit continue, and then you would just have to get filled at the strike price. So say you go one contract, 760, and then it'll go out as a cost order of $760. Now, the next question, which I think is an important one, is when do you buy puts versus when do you sell puts? Now, if you take a look at Amazon, even the 215, for example, here, right now your implied volatility is at 56.18%. Now, what that means is that there's a lot of implied volatility. There's a lot of move in the market or in the stock here. And what you will see here, take a look. So remember, 56.13 for this one. If I go to November 7th, it's only 48%. Now, why is that the case? Well, because again, as Amazon gets closer to their earnings, the implied volatility will go up. And as implied volatility goes up, that means there's a lot more uncertainty with the stock. There's a big move that could be expected. And with that being said, if there's a big move and there's more risk associated, that means the premiums are going to be juiced up a lot more. If the volatility is lower, that means that they won't cost as much as a result. So keep that in mind. So I wonder let's take a look at October 24th. The 215 for that one is only 33% volatility. Again, there's not much happening for Amazon this week because there's no earnings until next week. But as you will see Amazon get closer and closer to earnings, especially on this week here, this implied volatility number will go up. And as it goes up, that makes this cost be a lot more. So the question is, well, Fridge, when do I buy options versus when do I sell options? Well, selling options is when you want to maximize that premium, okay? So if you want to maximize that premium, you would want to sell a put option at close to around that earnings expiration date because your volatility will be a lot more, there'll be a lot more of a higher implied volatility. So say you want to sell a cash secured put, which means you'll be buying Amazon at $200 each for 100 shares, which will cost you about $20,000. But you'll get paid about 1% just for this stock right here at a $200 strike price, $2.41. If you go to November 1st, the $200 strike price will be a little bit more, but it's not much more because the volatility is a lot less. So if we get closer to earnings around like October 30th or even October 31st before market closes, if you look at this $200 strike price for Amazon, it's probably going to have a juicier premium because it could have a risk of assignment. So you want to sell options during earnings because that's how you can maximize that premium on implied volatility. Okay, that's something that's very important to keep in mind about. Okay, and you want to buy a put option way before earnings. So for example, like Nvidia, for example, maybe not Nvidia as much, but we can take a look. Nvidia doesn't have their earnings until much later, I believe, right? Their earnings are November 19th, so they're going to have about a month out here. So you go to trade options here, you would buy a put option here, and you would want to buy an option when the IV is low. So if their earnings on the 19th, say you buy one for the 21st, right now the volatility is a lot lower. But as you creep up to those earnings, this is going to increase. And what is that going to do? It's going to make the premiums more expensive. So you want to buy puts when you have a lower implied volatility and sell puts when you have a higher implied volatility, because that means that you'll be able to maximize premiums when you sell options and collect passive income. So if you wanted to buy, say, the 165 put option here, it only costs you $3.80 per share, or $380 right now. But as this IV goes up, this will hopefully have more value to it because there's more of a risk of Nvidia coming down after earnings. So that is why it is best to sell options around earnings and buy options when there's low volatility. If you want to look at the historic volatility of a stock, and the historic volatility is 30%, and right now it's trading at 60, you're looking at selling options. And if it's around 30% and your IV is 35-ish, maybe, whatever, around that area, then you'd be looking at buying options because that means your IV is more likely to expand. And when you have that expansion, it makes your options contracts worth more because there's more of a risk. And that would make you more profitable when you're buying options compared to selling for the put side. So again, buying a put option means you're betting that NVIDIA, for example, will go to 170 or actually lower because you got to factor in the premium you pay. And if you sell a put option at 170, you're saying NVIDIA won't go that low, but you get paid this credit up front. And if it goes to 160 or if it goes to 170, you will then be forced to buy the shares at that strike price. So that is the ins and outs of options and put options. Again, how you would open it up. Again, if you want a quick recap, buy a put, you hit this. You're buying it, you're betting for it to go lower. And again, keep in mind that that's not your break even. Your break even is the strike price, but you got to factor in how much you pay for premium as well. So my break even is actually 165-ish or so. So more of a move than what you might expect. It's actually like a 2% move because 170 is a 7% downside and 165 is a 10%. You're looking at about a 3% extra additional move. You got to factor in this premium that you are paying for as a result. So that is how you buy options. Again, buying an option is good when IV is low. Selling an option is good when the IV is high. So thank you guys so much for watching today's video. If you didn't make it this far in the video, please make sure you like the video, subscribe to the channel, and if you have any more questions, leave them down in the comments section about how puts work, how to open them, how to close them, how to manage them. Let me know down in the comments section as per usual. And I hope you're always making money in the market in some way, shape, or form. And as always, I will catch you guys in the next video.